something.
Preferred return of 6. Okay. Yeah, again, it's the alternative investment alternative.
What is it?
Buying SunTrust bonds.
Oh, that's 6. Do you typically try and document why you put that in there to show your investors, or you just
No,
no?
because a lot of investors will say, I need an 8. I don't want a 6. Okay, we'll talk
They'll
about
make
the next
it,
one.
right.
So,
And for your NPV, you use a 6, or do you use your weighted cost capital?
Here it's NPV because it's single tenant. Weighted cost of capital I would probably use if I had multi-tenant in something longer term.
Okay.
Yeah.
What about like a hotel? I don't like that NPV. I don't understand that. You know, I guess above 0 you're okay, but because you want to be able to pay your equity and your debt, so you use your weighted cost capital in any scenario to show at 0 NPV you're at least funding your liabilities.
Yeah. That's why I say the NPV is good for this, because this is pretty static. In multi-tenant, you're probably going to be looking at, something that's more dynamic. You're going to have to look at it from a weighted cost of capital basis. Yeah. Here, yeah, I mean it's one lease, one rental payment, one debt service payment. You can, but I mean NPV is kind of irrelevant in this altogether. But if you needed it, I would only use it for this instance. Does that make sense?
Well, when calculating the net present value, would you use a weighted cost of capital or your 6% hurdle rate?
6.
Because it's single tenant though.
Right.
It's more for, it's an AOP question, it's not yours, but I just, because we were looking at it, we've got a hotel and a retail site, and we're using the weighted cost capital model for the NPV.
Yeah, that's probably accurate. Just again, because it's such a dynamic income stream. We're using floating or fixed rate debt too.
Thanks.
Okay. Yeah, that's probably right then.
But our hurdle's much higher than 6.
Right,
So we can-
as it should be, yeah. So, just from, again, sources and uses, pretty straightforward. This is also taken into consideration. I simplified this worksheet and kept it in there as some of the items that I would use if there was some construction component to this that was anticipated going into it. So in the event that there was an opportunity for a phase 2, or tenant wasn't responsible for as much as they are in this instance, I'd have to certainly budget for a new roof, or to be able to some marketing costs or something like that for attracting tenants if we weren't fully stabilized here. But this is pretty quick and dirty. Yeah.
Is the acquisition fees that what you had from your past experiences?
2%?
Yeah, this one right here. It says here it's like 1.7 for acquisition fee.
What cell are you in?
I'm in sources and uses.
Yeah. Which cell?
Sorry, hold on. F75. Is that the one that you talked about earlier that you've had in past experiences for your fee?
Yeah. I mean, it's even a little bit on the high side.
Yeah.
Working capital is also a little bit on the high side
Matt, do they try to cap
for
you?
a single tenant deal.
They ever put a cap for an acquisition fee if you're getting crazy?
Sometimes. Sometimes I don't even take one either.
Right.
I mean, it's all it's very fluid, put it that way.
But it is deserving. I mean,
Yeah,
You get
well,
pushback from that?
what's that again?
You get pushback from that?
You can get pushback on any number of sources. You can get, starting at the purchase price. But yeah, I mean, I took a very nominal soft cost contingency, and so I get pushback on, do you really need $475,000 of working capital then? You know, when it's a triple net, you have no responsibilities. So that's certainly, you know, something that's worth pushing back on. You know, it's $13 a foot. You know, I'll get pushback. It's like, well, what are you doing with $13 a foot sitting static? You know, when you don't have any responsibilities during the term. So that's real money. I mean, $20 a foot in total soft costs when there's no construction, there's nothing there. But again, it's kind of prepping for that rollover. Okay, I don't want to have to call capital if 12 months prior to Ken Spring giving notice, do they actually, you know, depart, and I've got to call everybody and say, oh, well, they're actually leaving, and I need everybody to pony up, you know, because we need $20 a foot to break this thing into multi-tenant markets and new tenants, you know, and go and track down and chase people to come and occupy the building, backfill the income. So I'm a little bit proactive in that nature, as are most.
And
And
plus,
if you do a capital call and they don't have it, you just adjust the ownership percentage of what
Yeah, well, it's
people put
tough,
in, like,
because a single tenant deal that could be potentially vacant, you know, and people are like, well, I'm washing my hands because we're not gonna get that 448 a foot, you know, exit per square foot. And so, you know, I want to have people committed to it up front. You know, let's just plan for it up front so we don't have to have that conversation. So everybody's kind of mutually aligned, you know, in it to win it, if you will.
and plus the working capital consists of a couple of bucks per square foot for your car.
No way. No, I actually am one of the few, I actually have audited financials every year.
I get you.
So, yeah, it's a big expense actually.
I get you.
But I want to be more than transparent to everybody. You could certify it and just have like, you know, Price Waterhouse come in or something like that. But no, I take a lot of pride in that.
Do you have your company get like rated by a credit agency? You not trying to do that?
Not yet.
No. That's an incredible expense.
Yeah.
Oh my gosh. To go to try to get a rating?
Oh, yeah.
Yeah. I mean, there are, so Store Capital that I took public last year, I mean, they have a $2.5 billion market cap and are still considering whether a rating is worth it or not.
Yeah.
So a little far away from that,
Slightly.
slightly. Yeah.
You can't get financing from KeyBank because that's conflict of interest, or you can't?
Yeah.
You can?
And
And they know you're, like, they know that you do this on the side, that's not a
yeah,
conflict, or?
yeah. I mean, it's you know, very straightforward. Distributions, we'll get to that. Distribution sensitivity, we'll go further sensitivity in the last worksheet. So this is really specific now, kind of for the waterfall. And take a look at this before I start talking through it, so you just know how it's made, A, and B, if, you know, the promotes are, you know, there's a 20% promote in the exit of this too. So take a closer look, if you haven't already, to look at these hurdles, because this is very, very practical approach.
We got some IRR lookbacks.
I'll just give you 5 just to kind of digest it all. So as you saw, kind of cash flows distributed in each operating year, for this Chapter 8, basically looking at it from a JV perspective, and how initial capital translates to the 5-year hold on this for the exit.
The sponsor's not putting any money in the deal?
So I removed all the different ratios. So it's not, this isn't completely practical, but the numbers are all there.
You don't even calculate your IRR if you don't put any money in.
Infinity.
Wow.
Yeah.
Everyone's a critic.
Matt, do you show this to the bank when you're getting financing? This Excel model?
For a deal like this, no.
Just give me some cash. I got this.
Yeah, I'll take it from here.
This is
No, actually, the bank doesn't take into consideration any future cash flow. So they're underwriting based on today's income.
Gotcha. You just
And
take like leases to them.
what's that?
You just take the leases basically to them.
Well, yeah, like I'll show them what the tenant's paying this year or at closing, and that's what the bank will, for fixed rate debt, that's all they're going to underwrite. They don't take any bump into consideration. They don't take any of my expenses from the management side into consideration because they are purely looking at it from a non-recourse perspective. So
They take the lease term into consideration though, right?
very much so, yeah, the lease term, but they don't care what the tenant's going
Right.
to pay next
Sure.
year because they're doing fixed rate non-recourse loan today. Because it is stabilized. There's no reason to get a mini perm. There's no reason to get any construction loan. There's no opportunity there. So yeah, it's really just a rent roll, which I would create one tenant, square footage, annual rent that they're paying right now, lease commencement and expiration date, and that's it.
And what kind of DCR would they be doing this?
I think they want to stay like on at least 1.3. The problem of this though is it's going to be more leverage constrained than it is going to be debt service coverage constrained. Because the rents are below market and I'm paying a premium per square foot. And that sales comp isn't probably going to be as readily available in Jupiter at, what is it, 334? Yeah, 344, excuse me, a foot. So it's probably going to appraise out for $10 million, I bet. So, but it's a unique deal. I mean, you can't, where you see like a Walgreens triple B plus, or excuse me, triple B, rated S&P triple B tenant. So you can see that those are all kind of trading nationally. And you're just going to have 5 other sales and rent comps of a Walgreens. Here, you know, you're not going to comp this out with a Walgreens, and you're not going to comp out. It's going to be harder to comp this out from a rental and sales perspective because it's single tenant A and B. It's investment grade single tenant, and there's just not a lot of those that you're going to be able to point to in kind of Palm Beach County. So they're probably going to be using some multi-tenant comps, which I know are not going to be $344 a foot in value, and there could be some that they might find, you know, in other parts of the southeast, but it's going to be hard to comp out.
And they'll take the lower of the two.
Oh yeah, yeah. Because again, non-recourse mortgage, the bank's always preparing that the day after closing, I'm going to walk in and throw the keys back and say I don't want to own this thing anymore. And it's like the most, talk about conservative, that, you know, the bank, when they see this distribution, you know, or sensitivity worksheet,
They'll take the red one.
what's that?
They'll take the red one.
Maybe not quite red, but pretty darn close. Yeah, I mean, there's no upside in the bank, you know, so they're going to say, I just assume the absolute worst case is I'm going to own this building, and they're going to underwrite the tenant, they're going to underwrite the market rents. What's my downside risk? How do I get hurt in this loan? And I'm going to underwrite to them in those levels. So they can underwrite the below market rents, great, and then they're going to underwrite to the appraiser's concluded value, which is going to be based off of like-kind rents and sale comps. So it's going to be difficult.
So if you have a building that's, say, 40% occupied, and you wanted to buy that, how would a bank underwrite that? Just off of the NOI?
No.
Or the rent side?
I mean, it's going to be, you know, a non-stabilized quasi-construction loan type of structure.
Okay.
So, I mean, it's going to be more of called a bridge loan because there is a cash flow component to the building. So it is qualified differently. So if you're 40% occupied and that 40% is kicking off cash flow, you're actually going to be able to. The bank doesn't have to reserve as much against it as if it was construction, ground up construction.
Yeah.
So it's a kind of totally different risk profile. So you're going to get, you know, a 2 or 3 year type of mini perm loan that might have some recourse to it. If it's non-recourse, it's probably going to be priced quite a bit more in a premium to offset that risk, because then you're going to be looking at it as, okay, it better be a fantastic sponsor who, you know, buys distressed buildings all the time, or has a tenant in their back pocket, or maybe it's pre-leased. You know, we work with a big operator that buys distressed shopping centers around the country. You know, kind of 40–60%. Give them 70% acquisition financing, but it's usually like 50% recourse. And once you can get to a level of market occupancy, then the recourse burns off. So at least there's something that keeps the sponsor motivated, but 50% recourse is kind of nice too, because you're only responsible for the first half of the loan. So it's just it's structured differently, you know, 2 or 3 years probably, you know, to get in there, and if it's capital improvements, if it's leasing, something meaningful to be able to get the property stabilized, either sell or refinance into a permanent loan.
And you figure 85% LTV on this from the bank?
What?
85%?
No. I wish. That'd be
Oh,
interesting.
it's on the financing assumptions. It's a senior loan.
Oh, well, yeah, there's also, do you see the second amount of debt that's related to it? That's in the event that there was a unrecorded kind of unrecorded kind of soft internal you know, debt piece. So some investors, instead of taking equity risk, will say, I'll be behind I'll be in the equity, but I also have some kind of almost like a mezz
Yeah.
type of approach to this,
Okay.
you know, or preferred equity. So it's structured as that. That's which I wanted to be able to talk further about. That is, I mean, most banks don't want to have anything recorded subordinate to their first mortgage, but you're able to then structure preferred equity typically. So instead of being able to say, and it doesn't fully resonate in this because you only have one cash flow anyways, but if you had like, you know, 5 different tenants in here, and you had varying lease expiration dates, there would be an opportunity for, you know, some investors say, I don't want to take as much equity risk, but you know, I don't care as much about the upside, but I don't mind kind of a static 7% just return on my money. So it's just a different type of distribution model, which is becoming more and more common. Some investors really got spooked going into the Great Recession, is that, hey, we were all in on this just great upside. My managing member or GP partner said my IRR was going to be 25, and it was just going to be this is going to be a total home run deal. And they were all in, and now all of a sudden, you know, it just went poof, you know, gone. And either they lost the property, or they couldn't realize the IRR because they couldn't sell because the market just wasn't there at the cap rate that they were preparing for it, and they just missed the window of the market through probably third quarter 2007. Now I think some people are like, well, I'll take 50% equity risk, but I also want to maybe trim some of my downside risk, and I'll just take maybe some sort of just flat preferred equity risk. And then the lender doesn't care, you know, about how your equity is treated per se. As long as there's hard equity there, that's, you know, the whole manager side of it, the partnership side of it, that determines, you know, whether it's going to be some sort of static return or not. So, but I have, you know, it's very common in Europe and in Asia too, to have just that kind of preferred. All they just want is a very clean, predictable return, and then there's actually then bigger promote opportunities. So in the United States, we're all here because we want to have that 20% promote. You know, this is, let's see, hold on, let me actually make this even bigger.
How did you come up with the discount rates in those investor and
Well,
sponsor?
that's my hurdle.
But up in the investor one, it's at 12%, where your hurdle is 15%. If you scroll up just a little bit, right there.
All right, which cell you're referencing?
Scroll down, it's C, there you go, 150.
I don't remember why I put that in there.
But
Off the top
that
of my head.
generally should be your hurdle rate.
Yeah, I mean, it's a different way of looking at it. Let me look at it again, and when we take a break after lunch, because I just can't remember why it is 12 when I don't want to speak out of turn.
Sure.
But yeah, I mean, essentially, you know, the promote is where the 20% promote is more the focus. But I think the discount, I can't remember why I put a discount in there. I think maybe one of the investors wanted to see it or something like that. but, but yeah, so this is basically, you know, a little bit more, kind of the cash flows.
So the
sponsor
NPV
related.
is the value today over and above what I put in.
Yeah,
So if I give you $1 million, I'm gonna get my $1 million back plus $460,000. At today, if it was today. Is that kind of like what that's saying? Well, it's not $1 million, but if I give you X amount, I'm gonna get that money back plus.
Plus the 468.
plus the
So
468. So in this case, it's more the equity multiple there. So 2.36% dependent for your tier one is your return.
So that's saying if I give you $2 million, if I give you $1 million, I get 2.36 million back.
Yep. Yep.
In the future,
In the future.
and then NPV draws back.
Draws it back, yep. Yep. The NPV is all based on today and what that's worth if all the stars are aligned. And then this is just an extension of,
Why is that an important number? I don't understand NPV, why it's important, because you're not getting that money today.
yeah, you're not getting it today, but it's
Is it just a measure across different properties?
I mean, I look at it as more of a corporate measuring stick that,
This one versus that one?
correct.
Okay.
So I could either, yeah, it's a cost of capital almost, is that, do I want to go into this? Everything being equal, I can either put my money here or I can put my money there. Here's what this will yield, or what I hope it will yield based on what I know today. And, so you're really looking at it from you qualify it that way.
But don't you use IRRs more to compare investments? So
Yeah.
so if I have $50 million that has an NPV of $1 million, or I can make an investment that's $10 million with an NPV of $1 million. Maybe I can do 10 of those, or those aren't quite apples. to
Yeah, I don't
oranges.
think that's relative.
Right. So using the
Well, and I wouldn't
IRR
say it's only relative when it's 1 versus 1.
okay.
Of the same
Right.
amount.
When it's
the
an
same
apples
amount.
to apples.
Yeah.
Okay.
Or, I look at NPV as making more of like a corporate or CapEx
Okay.
type of decision making.
Mhm.
You know, whether, there's no income related to a lobby upgrade, but is that money really money well spent per se? Very project level. Yeah, it's not that, net present value, I rarely ever talk about.
Okay.
Again, because it doesn't really include the how relative and dynamic real estate can be.
Sure.
And the moving parts to it.
Right. It's
So,
all.
this is a very scaled down version of it.
Mhm.
And some of these numbers I can go through, but aren't entirely correct, and I kind of did it on purpose to see if anybody would catch them. Daryl said he caught 4.
Mhm.
I think he's wrong.
Like I didn't put that many in there.
What's that?
I use the MPV,
Do you?
yeah. I use it because I want to know sometimes, most of the times is, what is worth the future cash flows today if my discount rate is 20%? What is it that is today? Or even when I'm valuing a hotel, in the hotel sector you use it.
You do? Okay.
Yeah, you use it because you want to know the book value and you want to know the value of the company because you're not buying only the leasing income stream because it's an operational asset. So you have a combination between the operation, what it generates, and also the real estate percent. So you want to know what is the net present value of all those cash flows today to see if when you're making an offer, you have the company on one side and then the real estate on the other side, and then you combine both. So we do use it to understand the value of those cash flows today.
So then my
And the
question,
multiple, as you were asking before.
Equity multiplier?
my
Yeah.
question on it, if your net present value of a particular cash flows is $1 million versus it being $10 million, what does that really tell you?
tells me that if I have $500,000 today, if I'm gonna invest in you $1 million, that will cost me 568. I can make a decision whether I put it into your investment or I do something different with that money, that it will provide me with X amount of risk, or what it entitles to $568,000 today.
But you're getting your return in there, so this is over and above your return.
Well, it's your NPV of the cash flows. Of,
So like, I would look at NPV more as like.
It's
what is
how
the no
impactful that
return?
return can be or
Yeah.
could be. Again, I use the the lobby approach, but it's perfectly valid in a hotel lobby, okay, approach. Is that, are you gonna get your money, are you gonna get the return out of something that's not directly affecting
Yeah.
or affected by your cash flows? It's an enhancement, hopefully, of your cash flows. Is it impactful enough? So it's really the, am I going to get my money out of something that might not be a direct bottom line a cash flow generator?
So then, in that case, how do you bring it back?
So
Like, all right,
anything over zeros
Yeah,
is.
and so you think that you're gonna be able to bring it back to, over 0.1.
yeah. So,
That
what-
it's going to actually enhance your cash flow. But is it a good use of capital if you're capital constrained?
yeah.
That's the NPV, bringing it back, that cash flow that we think something could affect, something that can affect your cash flow over 10 years, that is gonna have a 10-year life, okay? And if you can bring it back and it's going to generate X, then it's a good use of your capital.
Yeah.
All being equal. And it's, because then you're also looking at it as, okay, I have 2 different hotel lobbies I could do it to. And where is it gonna be most impactful over a 10-year period of time? I might pick this hotel and put more money in there and leave this one alone, or do I break them up? Maybe I don't go marble floors, but I do laminate on both or something like, marble on one, or I do laminate on both or something like that, That's, I don't use NPV all that often, again, just because we're here to drive cash flow to the tenant level, at the tenant level. So it's IRR against tenant improvements, not CapEx. CapEx is just a cost of doing business. CapEx is just keeping the lights on, keeping the real estate relevant that actually people won't even rent from it. So you really want to be able to drive it down to the tenant level. And then actually it's like a soft goods package at a hotel. You've got a Marriott, and you've got to upgrade all of the bedding, what else? Whatever that package is going to include, that's actually a cost of relevancy to your flag in the term of it, but you're really looking at that from an IRR perspective, not NPV. Would you say? I'm not a hotel guy, but that's it.
What does that mean?
well, first of all, I'm using it right now to value a GP, and making an offer on a GP.
Okay.
So, because how do you value the company, a GP company, an asset
Right.
management company? Is by
Yeah,
the
it's
promote.
only worth what cash flow you can pull out of it over a certain term.
The promote.
Right.
So discounting to an NPV, that's basically what it's worth today, that particular company.
Yeah.
Mm.
Right, because it's an operating company.
Because this is an operating company, for that is like you said, it's more different.
All right. These guys are already checking out in the back. Break for lunch, I guess? Ready?
Yeah.
Break.
Monday.
And so, huh?
We need like 2 hours, I think, for the presentations. We should be good, right?
You want a 2-hour lunch?
No. I'm saying as soon as I like
What are you saying, Ty?
One, no,
It's what we usually
We'd
get.
like some time.
like 12:45.
Go grab a sandwich, come back.
If we're back by 12:45, that gives us time to start at 1, and that gives us 2 hours to do all of our presentations, which is probably enough, if not too much.
Nice little sales pitch, Ty.
So Tyler's group is going first at 1 o'clock.
Nice.
We'll go first. We'll go first.
So what I would encourage everybody, so just take an hour, that 15 minutes, everybody can use between 12:45 and 1 to plan, because then we're just gonna jam through all the presentations, and the presentations, PowerPoint, Excel, questions from the audience, and we'll kind of open it up to, call it a half an hour per presentation. And, but I encourage everybody 12:45 to 1 to get your plans together, even though the awesome group that's not quite that awesome. What do you guys call yourself?
Bam? 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 Get out of here.
I have a question now.
Yeah, man.
Hey, one just for it.
I'm just gonna go grab
We're working on
the
another
mat.
issue.
Knock this out. Easy, that's it, right?
And one of the things that is percent we're working on, don't worry about it. I got it. Because I'm a regular way, person comes in. She said, oh, no, but my target red lights.
Spot?
No, you all of the shopping plazas. Very well.
Yeah, I thought you sold that.
No, actually, he's finalizing the refinancing process.